Hello, I'm Andrew Beck, Senior Financial Planner here at Omniwealth, and welcome to our Investment Committee update for April 2018. Both international and domestic share markets are trading at their lowest levels for the year. Our local market is down just under 5%, the Dow Jones down about 2.7%, China's down 4.5%, and markets across Europe are down about 1%. Our market has mostly been weighed down by bank stocks after a shift in sentiment following the start of the Banking Royal Commission, and we're seeing political events around the globe impact global markets. The big news of the month was that US President Trump has threatened to introduce tariffs on Chinese imports to the USA, and in return China has threatened to retaliate with its own trade sanctions. So we're watching this space closely and what impact it will have on global markets. Oddly, as shown in this month's graphic in the newsletter, America actually exports more to China than what it imports, and what this has led to is a historically low rate of inflation and low interest rates in the US economy. So at the moment we're seeing our market trading just above levels of lows between May to September of last year, and we think we're seeing now a bit of a rally following our investment committee midweek. So what we do think is it is appropriate that if you do have some surplus cash, have a chat with your financial planner, and if you've got a time frame of more than 5 years before you need to pull out or use that money, may be a good time just to dip into the market and add to your existing portfolios. During the last month, we saw performance figures for residential property around Australia released, and Hobart and Melbourne were the only two capital cities in Australia to record double-digit growth in 2017. Sydney and Brisbane experienced a lower rate of growth compared to their previous years, definitely reflecting our expectations of a cooling of capital growth within the Sydney market, and Canberra experienced an above average return compared to the 8 capital cities in Australia. Positive news for investors in Canberra. And Darwin and Perth were the only two markets to experience negative returns in 2017. So we reiterate that property is a long-term investment. We always say to our clients, you need to hold a property for a minimum of 10 years, which is a full economic cycle. And we've had a few queries from clients asking, is it time to start investing in the Perth market? At the moment, we're not recommending that. We think the fundamentals just aren't there yet. There's still not enough net positive migration. We're still at the bottom of a commodity cycle, which is recovering, but it's not a market that we're ready to start making recommendations on yet. In regards to the lending space, there's been little change since our update last month. We know that market conditions continue where banks are heavily in favour of offering principal and interest home loans, and that's on properties that you live in. But we're now seeing opportunities for clients who may still have interest-only rates for their home debt to consider moving to principal and interest repayments, and this is because the discount can be up to 1% compared to the interest-only rate. This will vary from each person's personal situation, so have a chat with your mortgage broker or financial planner here at Omniwealth. One thing we do know, and it's a positive sign in our opinion, is that the appetite of banks wanting to offer interest-only loans for investments is returning. And this is a positive because when you have an interest-only loan supporting your investment portfolio, the outgoing commitment to service that is a lot lower and the debt is all tax deductible. So that is still our preferred way to consider helping you get some more capital working for you. So that's a summary of our investment committee for the month of April. As always, if you've got any questions, please contact your Omniwealth advisor. We'd be more than happy to help you. Thank you.